If you go look on his site at propthink.com, you'll see that he's been doing stuff with Yahoo Finance, Reuters, Google Finance. So he's got some press, MarketWatch. So he's decided to come and spend a lovely Saturday morning with us here, and I'd like to thank all of y'all for coming and spending this Saturday morning with us here. We have him and then two more up after him. So Jake, I'm going to now make you the organizer, and then I'll make you the presenter, and you'll be able to see everything and take over the PowerPoint. It sounds like your mic might be live.
Hey everyone, Jake here. Thanks for joining.
Okay, I can hear you. I
Great.
can see your PowerPoint.
Great.
There you go. I see. Everybody see that? Y'all give me some yeses. Welcome this guy. It's his first time here. We're excited to have him up on deck.
Hey,
all
Jeanette.
All right. Yep. Yes, sir. What?
Cool, you got everything?
Yeah, do you see the questions? Do you see how to pop them out? Did they come up on your little, you have a little box? Okay, all right. Just want to make sure you can see those. And if at some point you get where you can't see them or you need my help, I can read them out to you.
Cool. Thanks,
Okay.
Jeanette.
Sure. Go ahead. You have 1 hour.
Hey, thanks. Welcome. Thanks for coming, guys. Webinar, Profiting from Biotech, No Matter the Market. So big shout out, obviously, to Trade Thirsty for putting this on. This is my first time at a Trade Thirsty event, but I'm aware they always put on a great educational event. So thanks for showing up. Before we get started, just a quick disclaimer, nothing you've never seen before, just acknowledging that trading and investing obviously involve risk, right? So before deciding to participate, you should examine your investment objectives, your level of experience, and your risk appetite. Okay, so nothing you haven't seen before. So you're here to learn about biotech, right? In the next 45 minutes, my goal is to talk to you about profiting from big moves in biotech stocks, which I'm sure as active traders you see all the time. I'm also going to talk about a really simple setup that can return 15-20% plus in days and happens on a fairly regular basis. And I'm going to talk about how to predict those big moves or predict the magnitude of those moves from biotech stocks, the amount that these things will move. So I'm sure you guys are familiar, you see these big moves all the time, right? You see the headlines, but you might not know exactly what's going on. So why biotech pharma and the healthcare space, right? I get this question all the time. I have two perspectives on this. Number one is the trading perspective. This is why you guys are here for the most part, I think. So trading perspective is we have these binary events, these catalysts, all the time, no matter the market conditions, right? So these, when I say binary event, I'm referring to an event with one of two outcomes, right? Good or bad, yes or no, stock goes up, stock goes down. It's a binary event. These are what cause those big moves you see all the time in the biotech space, plus or minus 30%, 40% in the course of a single day, right? So that's the trading perspective. These happen all the time, and while market sentiment might sort of affect how they react, we're still getting these big moves, so we're still getting a lot of volatility, and that's what we're after, right? Number two is the investing perspective, which is all about these sort of sector and demographic tailwinds. So I do both. I like the investing perspective. I like the fundamentals of the biotech space. I'm kind of a nerd. I like the science. But if you think about these demographic tailwinds, this is as simple as a burgeoning global population, right? The baby boomer generation all approaching retirement. So that's going to put a burden on our healthcare system. That's going to create demand within the healthcare system for quality and improving products, right? And then you have things as simple as these scientific tailwinds, where we are finally applying all the information we got from, I think about the genome, the mapping of the human genome, complete just over a decade ago. When that happened, a lot of people thought, oh, this is going to unlock tons of value and therapeutic value within science and medicine. It really didn't happen right away. It's now 10 years later, and we're just now seeing the fruits of that labor. And additionally, think about something like the human genome. I think initially cost over $2 billion, the first mapping of the human genome. Today we can map someone's genome for about $5,000. So huge leaps forward in scientific progress, right? What's really awesome is you can do both. You can trade binary events, you can trade these big moves. You can also invest for the long term. So that's what I really like about this space. You have a lot of opportunity, and no matter the market, we're getting these big volatile moves. So I want to point out, a lot of people, if you are a constant market watcher, you'll be aware that biotech has underperformed for the last few months, had a tremendous last 3 years, right? And got a lot of credit for that, got a lot of press for that. But what I want to point out is that this is not just a recent phenomenon, okay? So biotech, if you go back about 30 years, what I have here is a chart of the biotech, the BTK, which is the NYSE ARCA Biotech Index. This is the longest running index tracking this sector. If you go back about 30 years, and this chart doesn't actually capture all of the data, you'll see that this thing has been doubling, this sector has been doubling in value every 3 to 5 years, 2 to 4 years. This is a logarithmic chart just to show that performance a little better, but this is really, I would argue, is a secular bull market. And while I think the space sort of got a lot of press for the outperformance from 2013 to middle of last year, 2012 and middle of last year, this is not a recent phenomenon. And this is logical, right? Just like I was talking about, there are demographic tailwinds, there are scientific tailwinds, and medical tailwinds sort of driving performance in this sector. So it makes a lot of sense. So those are the two perspectives. Who am I? My name is Jake King. I've been ranked a top 10 out of about 8,500 financial experts, bloggers, writers, Wall Street analysts are all ranked on tipranks.com. You can find me there. I've been top 10 for the last few years. We're Interactive Brokers, featured research provider. You can see some of our details there. There's some photos of me, not the one on the right. That is my son. And you can see some of the places where I've written as well. I write for Forbes on the regular. But I was initially attracted to biotech for the volatility. Same reason that which I was just talking about. And I think this is why most traders start dabbling in the space. Big moves in short time frames. But the more I sort of explored the technicals, the more I started to get much more interested in the fundamentals and the science, the stuff driving these moves. So my background educationally is in journalism and English and Lit. So I've kind of fallen far from the tree in terms of my career path or where I thought I might go. But finance has always been something I've enjoyed. The markets have always been something I've enjoyed. My father's in finance and wealth management. It's always been something I've been interested in the side. But besides undergrad, courses I took in my undergrad degree, I'm totally self-taught from a science and medicine perspective. And I think that's important to point out because if I can do it, I think really anyone can do it. So I've spent a lot of time obviously educating myself, and with PropThink, with my newsletter, if we have unanswered questions about a particular therapeutic area, or if we have questions about something that our contributors can't answer, we have a pretty wide array of backgrounds from our contributors, we reach out to someone that does, that can explain it to us or that can give us some insight. So, again, I'm not an oncologist, I'm not a nephrologist, so if we need to talk to an expert, that's what we do. We have a pretty wide network of experts, and if we have to pay someone, we do that as well. So, but look, the bottom line is the fact that I think that if I can do it, I think anyone can do it. I'm a bit of a nerd, and then I like to read medical literature. I don't think that's totally necessary to mastering the space, but look, I think that if you can master biotech, you can really master any other sector. And that's just because it's a combination of the norms, everything you're used to looking at, financial analysis, market analysis, and then you're taking in an understanding of the regulatory space, the FDA, the science, the medicine, and statistics also play a big part of the biotech space. But I think that's really what makes it super fun and potentially super profitable. You can get an edge by doing the work that most people don't even want to attempt, right? So that's really how you separate yourself. So enough about me. I want to point out, if you don't understand something, if you don't know some of the terminology I'm going to use here, don't be afraid to ask or go look it up. You might not understand everything, and that's A-okay. All right. So there's going to be a recording available, and I'm available for questions after as well. And I'll try to answer questions as we go here as well. So real quick, terminology, biotech, I use to loosely refer to development stage companies. These are usually smaller companies. Bluebird Bio, BLUE, you might be familiar with, Sarepta Therapeutics, SRPT. These are both really high-profile names over the last few years. I would be surprised if you haven't heard of them, if you're an active market participant. So again, biotech, loosely talking about development stage companies that usually don't have a product on the market. Pharma, of course, is the Pfizers and the Allergans of the world. These are the companies with commercial infrastructure, right? They're known for selling a lot of products and selling them well. They're maybe not necessarily known as much for developing drugs. So pharma, all about commercial infrastructure. And then there are the companies that kind of bridge the gap between the two, the Gileads, the Amgens, the Biogens of the world. That, these are the companies that kind of get a growth multiple because people are used to seeing them develop great drugs. They have a track record of great drug development and a track record of selling those drugs successfully as well. So they kind of bridge that gap. I just wanted to throw these terms out there and kind of loosely define them for you, or it's how I use them. The term biotech has kind of evolved over the years. But again, biotech referring loosely to development stage companies. So, let's see. So the trading perspective. Why you can always find biotech stocks that move. I'll give you some examples. Oncotherion, ONTY. This was spring 2015, a big winner for us. Ran about 120% over the course of a month. Initial pop was about 30%. That move kept going. These are the kinds of headlines I'm talking about. Big moves, short time frames. Bluebird, I just mentioned, BLUE, doubled overnight in December of 2014 from 45 to about 90 bucks, moved another 110% in the ensuing year to about 180 bucks. Things like Alkermes, ALKS. So this is a sizable company, dropped about 40% just this past winter when a highly anticipated depression study failed. Big disappointment for the street, obviously, but 40% move overnight. And Clovis, CLVS, this was also in the winter of last year. Alkermes was actually in January, I should say. Clovis was just in this past winter, dropped about 70% overnight, $2 billion in value destroyed, when the FDA requested some data that investors had not anticipated. It kind of revealed some things about their lead drug that no one really knew prior. So these are the big moves that I'm talking about, okay? I think it's important to kind of frame the life of a drug developer and explain why this sector is so different from every other sector. Number one, it takes 7 to 10, even longer years to develop and get a drug or a drug product approved, a medical product approved. So that's running clinical trials, proving that your drug is safe and then efficacious in humans, right? Phase 1, 2, and 3, you've probably seen the names if you don't know the details. And then the approval process, the regulatory process, where you're getting in front of the FDA and showing them, you have to prove to the regulators that the risk-benefit is there for your drug, that the benefits of the drug outweigh the risks. So 7 to 10 years where these companies are developing a drug, they're burning cash, and during that time, most of them have no revenue and no earnings. So that's important, number one, because no revenue is coming in to support the R&D costs, to support the G&A costs, to support just the cost of running the business. But it also means that there's no earnings to look at. Most companies that you're trading or looking at, often earnings are a big component of that, right? Or nothing else. These are how you value these companies. So markets are forward-looking, right? Oftentimes with drug development, to value these companies, you're looking 3 to 5, maybe even longer years out to think about what are those potential future revenue or future earnings going to look like, or future cash flows. So what we look at instead over this time frame are these de-risking events, clinical progress. So these are the drug trials, right? These are the de-risking events for those future revenue and future earnings. If you move from phase 2 to phase 3 of development successfully, obviously you're one step closer to ultimately generating revenue from your drug or your product. That means you can further de-risk those future revenue or future earnings or future cash flow. Same thing with regulatory outcomes, FDA approvals. EMA. EMA is the European version of the FDA, stands for European Medicines Agency. Again, these de-risk the future revenue and earnings. I want to point out, and this trade setup that I'm going to talk today is all about the approval and why the approval can be such an expected event. So, most novice investors, I think, would think about FDA approvals of a drug. This should really be, in theory, should really be the biggest value unlocking event for the company and for the stock, right? Just logically, it's the final step. It's kind of the final arbiter before you can generate revenue. Often not the case, which is what I'm going to talk about with my trade setup today. So this is all about de-risking the future. You're de-risking future revenue, future cash flows, future earnings, and that's why you get these moves as these companies progress through the clinic and through the regulatory process. I also want to point out that because these companies aren't generating revenue, so I mentioned this once, but that means that they're really reliant on the public markets for a decade to raise capital, for the most part. For most of these companies, they're going to conduct financings every year or two, And that means dilution for shareholders, right? Every time they issue new equity or new stock, that means dilution for current shareholders. So it's a long, arduous process where oftentimes you'll see these smaller companies have their share count really balloon over the course of developing their drug. And that can make long-term investing a little more difficult, right? You have to factor in more dilution. So reliance on the public markets for oftentimes a decade or more. So I'm going to talk about the phases of clinical trials briefly. I just want to give you enough background so you understand what we're talking about here. Initially, we're just going to use a drug for an example here, or a drug product. So initially, phase 1 is all about safety, testing a drug in healthy people. So you're looking at ascending doses. You're starting at a small dose typically. This is after you've tested your drug in rats, mice, monkeys, whatever it may be, in the lab. Now that's usually a 3 to 5 year process sometimes. So now you finally move into people. You're just looking at safety. Is it safe in healthy people, and at up to what dose? This is usually small studies, less than 50 patients. Again, often not in the actual disease setting that you hope to test your drug in, or that you hope your drug will work. These are healthy people. You're just seeing, if we test 5 mg per kg or whatever it may be and ascend that dose, at what point do we start seeing toxicities? At what point do we start seeing adverse events where people are getting sick from the drug? And that's, at that point you probably back it off a little bit, and that's where you're going to think about moving into phase 2. Phase 2 is all about figuring out, does the drug do what we expected it to do in the intended population, right? In sick patients, whatever that may be. Cancer, diabetes, etc. And at this point, you're also trying to narrow down that dose. Maybe you're testing 2 or 3 doses at this point. You've looked at your maximally tolerated dose from that phase 1, and maybe you've backed it up a little bit, or you've moved forward with that maximum tolerated dose. So these are the size of these phase 2 studies really varies. But something like Duchenne muscular dystrophy, which you're going to hear me talk about more today, DMD. This is kind of a muscle wasting disorder. It's a genetic disorder. It affects boys, and it's a very small disease. Not many people have this, but it's really debilitating, and it's also often fatal for these kids, and no treatments exist. No great treatments exist, I should say. So for something like DMD, a phase 2 study is probably going to be 25 to 40, maybe 50 patients max. So a small patient population, right? For something like diabetes, or for cholesterol-lowering drug, or heart failure, you might be testing this in 500 patients. Maybe even up to 1,000 patients, depending on the setting. So obviously the size of the potential market, or the size of the potential disease indication, can really affect your phase 2, phase 3 studies. But anytime you're doing any sort of analysis, the bigger the sample size, the better, right? If you think back to high school biology, statistics, anytime you have a bigger sample size, your data is much more reliable. So we always want to see big data sets. All right, this phase 2, you're nailing down, and you're hoping the drug does what you expected it to do based on all your development so far back in the lab, and you're trying to narrow down that dose. So phase 3 is really the nail in the coffin. This is when you're finalizing your dosing. You want to confirm that benefit. Again, you're looking at safety. You're always looking at safety. These are often called pivotal studies because they are pivotal to the approval of the drug, or pivotal to the drug getting on the market. And the FDA typically requires 2 well-designed phase 3 studies. Okay, now that's not a blanket statement, but for the most part, FDA, and that's the Food and Drug Administration, I should mention that, FDA typically wants 2 well-designed studies before approval, 2 well-designed phase 3 studies. So these, again, something like DMD, Duchenne muscular dystrophy, maybe that's 120, 150, less than 200 patients in a phase 3 trial because it's a small setting. There's a small population in total. Something like diabetes, where you're going to be treating a lot of people for a long time, or something like cholesterol, where you have a lot of people taking your drug for a long time, maybe most of their life, you're going to test this in a lot of patients and for a long time. Maybe as many as 10,000 patients for a phase 3 program for a cholesterol-lowering drug. And maybe you're testing it for multi-year to see how it does over multiple years. So it really varies. The size of these and the length of these can really vary depending on the disease setting. But the point is, the bigger your potential market or your potential disease setting, the more patients you're going to test it. So that's the clinical trial process in a nutshell. From there, you're moving into the regulatory process. Before you ever get to filing your filing approval, you do have interactions with the FDA. These companies do interact with the FDA throughout the development process. There are certain designations you can get that can speed up the development or the approval process for a drug. I'm not going to go into the details, but these are things like breakthrough therapy designation, orphan drug designation. They're given to drugs with potential in in unmet needs or really small orphan drug settings, like Duchenne muscular dystrophy is a good example. Some of them are really beneficial. Some of them are not that beneficial. But you'll see stocks move off of these designations and off of press releases related to these. Once you finally you've been through phase 3, through all the phases of development, you have successful phase 3 studies, you file a new drug application. You submit a new drug application, an NDA. An NDA is literally oftentimes a 500,000-page document. Don't worry, you will never have to read an NDA. These are huge documents that get submitted to the FDA. Once you've completed all the development process, you send it off to the FDA. FDA looks at it for about 60 days, just makes sure that everything's there, and then they'll file your new drug application. From there, it's usually about a year-long process before you get an approval decision on the drug. So, just very roughly, we'll say this is a 6 to 12 month process. Sometimes the FDA decides within 6 months, depending on the need for the drug. Usually it's about a year-long process, all in all. The European Medicines Agency, which is the European version of the FDA, similar process, some very stark differences, but all in all, it is about a year-long process.
Hi, it's Chris Groves, and I'm going to welcome you to CPA Master.
But look, really long, arduous process to get your drug through the clinic, make sure it works, make sure it's safe, and then finally submit and finally get approval. And here's what it's all about. So before you look at the left side, I just want to direct you to the B there, the far right of this chart. In black is the lead indication for a drug. Oh, let me step back. So LOA from phase 1 there at the bottom of this chart. LOA is likelihood of approval from phase 1. So this is historical data out of Tufts University. They put this out about every five years, just updating what the likelihood of drugs reaching the market is. So that black bar is your lead indication. So some drugs might be, an oncology drug might be used in lung cancer and then also get approved in breast cancer further down the road. So lung cancer in this case would be the lead indication. So what we're looking at here is that black bar is the likelihood of approval for a phase 1 drug. It's 15%. This is most recent data. There's other data out there that suggests this is lower, 10%, even lower than 10%. The bottom line is most drugs will never get approved. I think this is super important to understand when you're just sort of framing this whole space. I think it means you have to approach the space with a high level of skepticism, just because every company thinks their drug's going to get approved, or at least that's the story. But reality is most of these companies will never get their drug approved. 9 out of 10 will never get their drug approved, just based on historical data. Okay, so that's the far right. That's kind of a great way to frame this whole sector. Most companies will never get their drug approved. So let's move to the far left of this chart, and this is the likelihood of moving between phases of development. Okay, so that first one is phase 1 to phase 2. About 67% of drugs will successfully move from phase 1 to phase 2. This makes sense, right? It's fairly high. You're just looking at safety. For the most part, in phase 1, oftentimes you're not looking at efficacy, so you're just confirming that your drug is safe and that basically doesn't kill people in that phase 1 study. So, most drugs, about 2/3 of drugs, will get through this step. And, look, a sugar pill would make it through this step, right? So even if your drug has no efficacy or has no effect on a potential disease, a decent likelihood it's going to get through phase 1. So phase 2 to phase 3 is when you start to see a lot of drugs fall off, right? If you look at that likelihood of moving to phase 3, it's about 40%. So less than half of drugs historically have or will move between phase 2 and phase 3. That makes sense, right? You're starting to look at efficacy. You're trying to determine, does it do what you expected it to do? Obviously, the further along you go, the higher your chances of approval get. So phase 3, from moving from phase 3 to an NDA, about 68% of drugs will make it through this step. And then once you get to the NDA/BLA filing, a BLA is a biologic licensing application, just a little bit different. But ultimately very similar to an NDA, about 86%. So once you get to the point where you're filing your NDA, you have a lot of data to back it up. If you've even made the step to file the NDA, there's a decent likelihood you'll get approved, about 85% historically. Now again, you'll see other data out there, but I just wanted to give you an example of the likelihood of these drugs being approved as these things move through the clinic. So, all right, so here's our trade setup, the expected approval or fading the news. Most novice investors, I find, that kind of approach the biotech space, I mentioned this earlier, look at a drug approval and think this is the biggest event for a company in its existence. This is unlocking the future. This is where they start to unlock that revenue potential. This should really be the biggest event for the company or for the stock. Oftentimes, it's not the case. All right, and this is, I find, people who are new to the space, I find they're always kind of floored by this, this whole approach. So why is that? Okay, let's just look at this. I'm going to give you some examples, don't worry, but let's just look at this chart again. By the time you get to that NDA filing, you've got a good chance of getting approved. Now this is, we can't make blanket statements necessarily, but historically you have a pretty good chance of getting approved. And we can also look back at all that data. Investors can assess whether they think your drug will get approved. So high likelihood of an approval. And here are some examples. Okay, this is a company called MannKind Corp. Controversial name, you might have heard of it, MNKD. This is a chart from 2013 to about mid-2014 when their drug, which is an inhaled insulin product, was approved for diabetics. June 27th of 2014, take a look at this chart. Obviously, big day, a lot of volatility on the day of the approval. Check out what happened after. A 50% decline over the course of the next 4 months. So this thing had run from, $2? Just let me move. MannKind had run from about $2.50 as high as $11 in the year and a half leading up to the approval decision. When it was finally approved, the stock declined 50%. A lot of sort of uninitiated investors in this space thought this was going to be the big value unlocking event. Not so. In fact, the very exact opposite is what happened. Same thing with Keryx Biopharmaceuticals, KERX. This was a big win for us some years ago. And we actually were talking about the name from mid-2s all the way to 18. We suggested selling it at 18 before the approval decision for just this reason. September 5th, this is ferric citrate, the drug's called Auryxia. Today it's on the market. It was approved September 5th of 2014. Obviously a lot of volatility the day of. 25% decline in the wake of that approval decision. Stock did rally back about a month later, ultimately gave it back. The stock does trade at about $3 to $4 today. The drug has been a commercial failure. Well, it's definitely been a commercial failure so far. We were involved here from about 250 to 18, suggested taking it off, recognizing a lot of these risks. We've avoided it ever since. So another example where an approval decision was baked into the stock. Arena Pharmaceuticals, ARNA, you guys are probably familiar with Belviq. It's a weight loss drug, 20% decline in the wake of their, initially in the wake of their approval decision. Stock did rally back, gave it all back over the course of or gave much of it back, about 40% decline over the course of the next 2 months. So again, a baked-in approval decision. Amarin Corp, AMRN, 25% decline in the wake of their approval decision. And again, you'll notice one thing about all these charts is all of them have appreciated substantially in advance of that approval decision over the course of the previous year or 2 years. So how do we identify these? How do we take advantage of this? This is a phenomenon that happens usually I don't know, 3 to 4 times a year. It really depends on the year. I'll talk a little bit about that. But how do we identify them? First of all, this is not all drug approvals by any means. This is not all drug approvals. Something like Pfizer, when they get a new drug approved, you're probably not going to see this kind of reaction. Pfizer has a whole portfolio of drugs. Obviously, one is unlikely to move the needle that substantially for them. Even the larger biopharma names, probably a similar thing. This is not going to be affect most of these larger companies, and it's not going to be all drug approvals. But we can identify these faders pretty well, and what I love about this trade is it's pretty high probability when you get the right criteria. So we're looking for small companies where there's a lot riding on this single asset. All right, so smaller companies, we'll say small mid-cap, usually less than $5 billion. MannKind reached a market cap, I think, of $4 billion before their approval decision, which was pretty wild. So, we can't make blanket statements again, but, just less than a few billion. We're looking at smaller companies. We're also looking for companies with good or quality preceding clinical data, right? We want to have good reason to expect that approval. And the easiest way to see what the market expects is just to look at that move higher preceding the approval. We're looking for companies that have appreciated a lot over the prior time frame. So expectations, it's a good indication that expectations are already baked in, that the approval's already baked in. Oftentimes these faders are cult stocks. Maybe they have a really big retail following. They're names with a lot of buzz. There's a phrase in the trading world or the investing world: buy the rumor, sell the news. this approval decision, these approval fades are a really good example of that. If everyone's talking about the approval and everyone anticipates the approval, not many people are going to be buying the approval. So how do you position for it? It's really, honestly, pretty straightforward. Shorting the open on the day after approval has been consistently quite successful. So it's as simple as shorting the open on the day after approval. This is, you'll see a lot of volatility the day of the approval, obviously, as well, depending what time that comes. Sometimes it comes in the morning, sometimes it comes at 5 o'clock. So oftentimes the open on the day after approval can still take a position, take a short, obviously in this case, or pick up some puts, sell some calls, whatever your method is. And then covering is sometimes end of day one can be really profitable. You can be in and out quickly. That'll probably appeal to a lot of the guys on this seminar. End of week one tends to be a really ideal time frame, and we usually see that peak to trough during the first month or during the first few weeks after the approval decision. But look, beyond that, it really depends on the product launch. All of the companies we just talked about, all of their products have been commercial flops. So I think I'm just thinking back. Yeah, they've all been commercially pretty unsuccessful. So, and you might make the case that this initial drop, this fade the approval, is pretty indicative of long-term performance. So, and again, these are kind of somewhat controversial names initially. So how often does this happen? So here are FDA approvals by year going back about a decade. Last year, 45 drug approvals. Most of those were larger companies. We did not have as many small companies getting drugs approved last year. So last year, admittedly, we were light on these kinds of fade the approval decisions. 2014 was a good year for them. I talked about MannKind, talked about Carex. 2013 was a pretty good year. We had less approvals, but there were some smaller drug companies getting approval. 2012 was another great year for these kinds of trades. But ultimately, there's a lot of, FDA over the last 10 years obviously has been approving more drugs. Again, we're looking for smaller companies that are getting drugs approved, and usually it's their one or only drug in the pipeline, or it's their lead asset that everyone's kind of paying attention to. So how do we find them? Again, small cap, mid cap companies, usually less than 2 or 3 billion. We're looking for that move higher, that big move higher in the months or year beforehand, which is really indicative of where expectations are in advance of that decision. We're often looking for kind of cult stocks, various stocks that are much talked about, buzzworthy names, where everyone's already talking about it into that approval decision. To find these, we have a Catalyst calendar we make available. I'll talk about that a little more at the end of our presentation here. But this is, it's a pretty straightforward setup. It's a high probability setup with the right criteria. I think what's really interesting is for those that are a little more with some risk appetite, you can actually even, what's worked well is even shorting the approval decision before it happens, the day or so before it happens. Oftentimes short interest is high in a lot of these names that we just talked about, so maybe finding a borrow is difficult, so you can often take the position even the day or days before the approval decision, in which case you're taking advantage of both that baked-in approval decision, or a baked-in approval, but you're also taking advantage of if the drug were to get rejected, in which case the stock would obviously go lower. So this is a favorite setup of mine. Again, happens a handful of times a year. It's high probability, usually pretty good returns, and I think they're fairly straightforward to identify rather quickly. Okay, so that's our trade setup. What I want to talk about next is the stock. We're branding it the stock market seismograph. Okay, so this is how you determine in advance how much these catalysts can move a stock. So did you know that MannKind was going to drop, or whatever it was, $5 or $4 to $5 in the wake of that approval decision? There are some ways we can figure that out, or at least figure out what the market expects. So we're using the option market. Option market tells you a lot about expectations. Options are obviously forward-looking. I expect some of you are familiar with options, some of you are not, so let's give a quick primer. But Chicago Board Options Exchange, CBOE, has some great videos that'll catch you up to speed on options very, very quickly. They have, I think you've got to have some experience to start to jump right in, but CBOE has some great background. So what is it? At its most basic, it's a financial derivative that represents a contract sold by one party, which is the option writer, to another party. That's the option holder or the option buyer. So the buyer obviously has the right, but not the obligation to buy the stock, buy or sell the security at an agreed upon price on or by a specific date. So this is the call to put. the strike price, and the exercise date. So I'm not going to get into options in detail here, but there's some great resources out there like CBOE to catch up quickly on these. And they're videos that they're very quick. They actually have an app that'll walk you through most of it with some tests. So what are we looking at to determine the magnitude of these moves in advance? We want to know, we know company XYZ has a FDA approval decision coming up on, whatever date it may be. What's the market expect the stock to do? This is the same strategy that you'll hear traders talk about this with earnings for larger companies, an implied move of plus or minus 5%, whatever it may be. I want to show you one way to do this. There are actually a lot of ways you can kind of mesh them together as well. So what we're looking at is the at-the-money straddle. At-the-money straddle that captures the event. What's a straddle? A straddle is a bought or sold call and put with the same strike price and the same expiration. Obviously, that expiration here has to capture the event we're talking about. So the FDA approval, the clinical trial results, etc. Just checking the time. Okay. So at the money straddle, and it has to capture the event. I'm going to give you an example. Sarepta Therapeutics, you heard me talk about this. SRPT, drug for Duchenne muscular dystrophy. It's called eteplirsen. Kind of a fraught development process, controversial name, extremely high short interest. And this has had one of the most volatile last 3 years of any company that I pay attention to. So Sarepta now has an approval decision slated for May 26th, 3 months away, almost to the day. So PDUFA, you'll see that PDUFA date, you'll hear that term thrown around. PDUFA is just an acronym for the legislation, the laws that govern the approval process. So PDUFA. That is May 26, 2016, so it's coming right up. Before that, I should acknowledge Sarepta will have an advisory panel meeting. The FDA will have the advisory panel meeting, but what this is FDA brings in a bunch of outside experts in for a day, literally to the FDA, to talk about the drug, talk about the data, and ultimately usually vote on an approval, whether they think it's an approvable drug. Okay, so these are usually like 10 to 15 people, outside experts, not employed by the FDA. They come in, they talk about the drug. The sponsor, in this case Sarepta, will have an opportunity to make their case for why it should be approved, eteplirsen should be approved. The FDA kind of makes their case, outlining the risks, etc. There's a period where anyone can come in from the outside, so it could be patient advocates or even patients could come in and talk to the panel about their experience. This is yet unscheduled, but it's probably going to happen in the next maybe late March or April. These things typically happen 30 days ahead of the approval decision, so if it doesn't come quickly, that'll raise some eyebrows. But bottom line, the PDUFA decision, that FDA decision date, is the big event for Sarepta, May 26th. Okay, so May 26th is going to have a profound impact on the stock price. I want to point out that this company does not fit our criteria at all for our fade the approval decision. Here's the chart. Going back to, this is about a year-long chart, okay? So you'll see the stock's at $13 today. I think it closed just around $13 on Friday. The stock dropped off from $33 in January. They actually had scheduled another advisory panel meeting for late January. That was canceled due to inclement weather. Remember we had all that snow on the East Coast. That was canceled, but some briefing documents related to that advisory panel or advisory committee meeting were released anyway. These briefing documents come out 2 days in front of the panel meeting. They sort of summarize all of the data to date with some discussion from the FDA's review team that was looking at that particular new drug application. So those briefing documents came out anyway, crushed the stock because everyone said, oh my, FDA does not, or FDA reviewers are not very optimistic about this drug and clearly don't like the risk benefit. So today the stock trades at $13, which is where it traded at the beginning of last year. And I saw a survey just 2 weeks ago, I think it was, from Credit Suisse, saying that 6% of surveyed biotech specialists expected an approval for their drug eteplirsen. So expectations are really low, right? So this does not fit our criteria for an anticipated or an expected approval that we would fade. I would say this is kind of the opposite situation where an approval decision is going to have a really outsized impact on the stock to the upside, given low expectations. All right, so let's look at our at-the-money straddle and see what it says about Sarepta and the stock's move into and through that approval decision. So this is an option chain. This is just from NASDAQ. This is from, I think, last week. So it's slightly dated, but it's still pretty relevant at this point. So what we're looking at again is our at-the-money straddle. At the time, the stock was trading at about $12.35. So we're looking at our at-the-money straddle to determine what the market expects, or the option market expects the stock to do with that decision date. So May 26th is after May options expire. Options expire the third weekend of the month. May options would not capture May 26th, so we have to roll out to June, right? June 17 options will capture that May 26th decision. So if we look at that $12 straddle, what we're going to do is we're going to take the midpoint of the bid and the ask, just to account for transaction costs and illiquidity, et cetera. Obviously, there's about $1 spread there, a little more than $1 spread. So we're going to take the midpoint of that. So what does that look like? If you take the call, we're going to use the midpoint. It's about $4.30 that June $12 call would cost you. Okay, so $4.30 for the June $12 call. $4.30 for the June $12 put as well. So that's our straddle, right? Both sides of that. And so total cost about $8.60, give or take, just to account for transaction costs, et cetera, illiquidity. So that is an implied move of plus or minus roughly $8.60. I say roughly because this is a bit of an art, less so than a science. Plus or minus move of roughly $8.60, which means implied downside to, sorry, I just had to pop out this, there we go. All right. Implied downside move, $12.35 minus $8.60 to $3.75, right? Now, give or take. This is a little bit rough. This is an estimate. Implied downside move to $3.75 or implied upside move to $20.95 from this approval decision, okay? So we can also use the $13 straddle would have worked fairly well here too. You can use it today as well. At the time, it was also implying a move of about $9.50. So we're going to say, give or take, a move of about $9 plus or minus for Sarepta with their approval decision. Coincidentally, Sarepta has cash per share of right around $3.75, okay? So that should act as in theory, should act as a potential floor for the stock. This is their lead and really only drug that people are paying attention to yet. If it's rejected, they're going to have to continue. They're running another study, a phase 3 study, to try to prove the benefit, the small benefit they saw in the phase 2 study. If they were to trade, if this were to be rejected this time around, it could trade as low as cash per share, maybe even below cash, because people will expect them to burn a lot of cash over the next year. By the time they can go back to the FDA, they're going to have a lot less cash. It kicks out the timeline. So $3.75 is actually a very logical place for the stock to trade. And that is what our options are implying, right? On the other side, the stock goes to $20.95. I actually think this could be a little low, given the short interest, given the low expectations. I think the stock could very easily trade back to closer to $30 on that approval decision, maybe even higher. That's where it traded right before that those briefing documents came out, and right before sentiment sort of shifted the wrong way for Sarepta. So plus or minus an implied move of around $9 is what the option market is telling us. So again, I just want to emphasize that this is what the option market is implying, right? This is the collective intelligence of the market. The market gets things wrong. So it's a good caveat to understand that this is what the options, or the market expects from the stock. So here's a quick example. BioMarin actually has another drug called drisapersen, which is also for DMD. In November of last year, they had an advisory panel, which I talked about, an advisory committee meeting in front of the FDA. That went really poorly. But what I want to look at is where the stock was before that. In early November, the options market suggested a move. The stock was trading about $115, $112 when I was putting this together. The option market suggested a $23 move from that November 24th advisory panel meeting. So because November options wouldn't capture it, we had to look out to December. That was, the calls were trading at about $12, if I remember right. Yeah, sorry, the December $110 calls were going for $13. $110 puts were going for about $10. Essentially, markets implying a move to either 136 or as low as $90 in conjunction with the advisory panel. So sure enough, the advisory panel went really poorly for BioMarin, and the stock slipped to $90. It actually bounced very rapidly and went and sort of rallied back to $95, $94 in the immediate wake, which actually was a decent opportunity. If you knew that the market was suggesting this $23 move, that $90 area was a decent place to get long. So anyway, this is an example of where it worked pretty well, right? Option suggested a $23 move. We had pretty much that $23 move over the course of that until option expiration. So just to recap, for this to identify the magnitude of these moves, you got to be able to identify the date of the event. You're looking at the at-the-money straddle, and you got to make sure that expiration of that straddle does capture the event, the approval of the clinical trial results, etc. So to that end, I just want to give you guys a taste of why I trade biotech. It's a really fun space. It's it has its challenges, but I think as long as you can, you're willing to do the work, you can definitely get an edge in this space. This is why I love it. There are tradable moves on a really consistent basis. That's no matter the market. You get these big moves. You also have repeatable setups like the fade, which I just talked about, high probability repeatable setups. The trend is definitely your friend, always. We've got this demographic tailwind, and I think that the time is now. We've got some really exciting scientific progress being made. We've got gene therapy, altering the genes that may affect the person's, whatever their disease state. So a lot is going on right now. To that end, we're actually doing next month a multi-hour webinar, much like today, where I'm going to get into all the nitty-gritty of the biotech, basics of the biotech space. We're calling it Biotech Basics to Benefit Your Bottom Line. I know, a little laughable. We'll call it the Quad B. So it's March 19th. It's going to be a live event. We will make a recording available, okay? So if you can't attend live, feel free to sign up anyway, and you'll get a recording. And what we're going to talk about is how to profit from this drug development process, phase 1, 2, and 3, tactics for that. I'm going to talk about trade setups, proven trade setups. You're going to learn about the rundown, the fade we've talked about a little bit. We're going to talk about more trade setups. You're going to learn about determining the value or the potential value of these biotech companies, or about their assets, maybe valuing one asset. So we're going to have a worksheet for you, discounting the future, very simple worksheet where you can plug in some simple data to try to figure out what that drug or drug product or company is worth. You're going to learn about, you're going to get our Catalyst calendar, which shows you exactly when these binary events are coming or scheduled to happen, like approval decisions. And you're going to get red flags to avoid in biotech stocks. These are really basic go or no-go red flags and green flags in determining when something is tradable or investable. So all that, how to profit, $99 value, proven trade setups, $199 value, the valuation worksheet, $49 value, Catalyst calendar, $49 value, and our red flags, $49 value. Normally total value, $445. We're going to cut it and do $97 today. So it's March 19th. It's going to be a multi-hour event. We'll do Q&A. We'll talk a lot. And I'm just going to talk about everything about the basics of drug development and trading the sector, trading and investing in this sector. I'm going to talk about being skeptical. Again, I think that's really important to trading the biotech space. As I said before, most drugs will not be approved, so you do need to be a skeptic. The bottom line is, this is all about catching up to speed quickly so you can avoid a lot of the mistakes that novice investors make, including myself. I made a lot of mistakes when I first started. So, we want to avoid those mistakes, and I want to catch you up to speed really quickly. So for $97, if it helps you find one winning trade, like the fade the approval today, that's a 15 to 25% move pretty consistently. You guys know what you trade with, so you know what that's worth to you. So if it helped you find one winning trade or even helped you just avoid one losing trade, again, you guys know what you trade with, so you know what you make or lose on a single idea. What's that worth? At $97, we think it's a bargain. So go to propthink.com/thirsty if you're interested. It's March 19th. There will be a recording available if you can't make it. I'm also reminded that we're going to have a simple worksheet that's going to do all the work that I talked about with the stock seismograph. We have a worksheet available as well. We'll send out for those who sign up to this our March 19th event. So it's called Quad B, Biotech Basics to Benefit Your Bottom Line. Should be a lot of fun. I always like doing these webinars, and I like it more when we have time to interact. So propthink.com/thirsty is where you'll find that sign up. And I think it's going to be available through this weekend, and then we're going to shut it off, but the event is March 19th. So, and again, recording available. If you miss anything today, we're going to have a recording, or Trade Thirsty will make today's recording available as well. All right, so look, I haven't taken any questions yet, so let's quick get to some questions. I have about 8 minutes. Thanks everyone for coming. Fun event. I always like doing these educational events. So someone asks, do I have a chat room? The answer is no chat room. My product, PropThink Premium, is a newsletter. You'll hear all about that in the March 19th event. We'll have a special discount available as well if you're going to that special event. So, all right, hold on. I'm just trying to find all of these questions. Some of these are old. So, sorry, I can't see the questions yet. I'm having some lag. So just give me 1 second. Can you hear me, Jeanette?
Yep, I can hear you, so I was just going to go start pulling some for you.
Yeah, I don't know if I'm just getting lag or what it is.
I don't know. It's technology. Sometimes it works, sometimes it acts silly. Okay, I'm just going to start asking. All right, what caused SRPT to crash on 15th of January?
So that was the briefing documents related to the advisory panel. So again, that advisory panel, a bunch of guys come in, outside experts talk about the drug with the sponsor, in this case Sarepta. 2 days in advance of those, there are this set of documents that are posted to the FDA's website. Those kind of detail or give background from the FDA on the drug in question. So they raise questions about the drug, they sort of explain their position on the drug or on the data so far. Obviously, those looked pretty bad initially. There were a couple facets of that investors didn't really anticipate, I think. That sent the stock tumbling. So that's what that is. That's really consistent. That's actually a pretty tradable event, those briefing documents as well. So you get a hint of what that advisory panel will look like 2 business days in advance of the actual event. So that's what sent it reeling.
Okay. How do you handle trading some of these drugs that don't have any volume? They have just low volume, or do you
the companies? Yeah, I mean, I guess it depends on your outlook. If you're trying to day trade, obviously it's much harder if even swing trade it. But I mean, it's a case by case basis. Yeah.
So just to take an extension of that question, the next question was, how do you deal with low liquidity and having to sell the straddle?
So again, we're not actually taking the position. I hope I made that clear. I should emphasize that. We're not actually taking the position with the straddle. We're just using the straddle to determine or to try to determine what the market expects the stock to do. And then we can use that expectation to maybe formulate a trading strategy around the event. I really like to use it to trade the outcome of the event, right? So rather than try to be predictive, sometimes it's better to be reactionary. You know what the market expects the stock to do. You have your own assumptions, so you can kind of trade off of that. To account for liquidity, I mean, look, typically you have to buy at the ask, sell at the bid. Again, you could use a combination of in Sarepta's case, the $12 straddle and the $13 straddle. There are some other setups you can look at. But yeah, liquidity can be the biggest issue, and it really depends on the size of these companies. Most of these companies that have options listed, they're liquid enough that you can get an idea of what the market expects. I should actually point out that it's often not the liquidity that's the issue. It's often the strike price, or how many strikes they have available. So some of these smaller companies will have strikes at $2.50, $5, $7.50, and $10. And if your stock's at $6, yeah, again, you probably want to take the average of the $5 and the 10 or the $7.50 straddle.
Okay. Chris wants to know what time your training starts on the 19th.
I think we're going to do 10 a.m. Eastern time. Again, that's going to be recording, so if you can't make it right away, you can always get the recording.
Okay. Let's see.
And we'll send out details. We'll send out details by email.
Okay. Someone's asking for you to please put the slide back up with the link.
Oh.
It looks like we see your whole PowerPoint.
propthink.com/thirsty.
Got it. Okay. What do you think about non-drug cancer cures like from Novocure, NVCR, FDA-approved treatment?
Yeah, that's a great question. Novocure looks like an efficacious product. I think categorically, medical devices are really different from drugs. And the way they sell and the way they're marketed, it's just a whole different bear. I'll say this about medical devices. Most of the really great medical devices tend to get taken out long before they go public. So if you're looking at small medical device companies that have gone public for whatever reason, I think approach that with some skepticism just because, again, they often get taken out long before they ever get a chance to go public. So I approach the medical device space, the small medical device space, with a healthy dose of skepticism. Novocure is a little bit of a different situation. I think they've got big shoes to fill, right? I mean, this is a product that did, just off the top of my head, I think it did $15 million in revenue its third year on the market. So again, it's not selling like a therapeutic you would expect a therapeutic to sell.
Okay. All right. Oops, I accidentally muted you. Okay. This question.
Go ahead.
The question I'm on right now is at 9:53, and I've read it a couple times. So I guess you would understand if you see it. It's how's the healthcare index broken down between equipment and supply companies versus services? Then that includes biotech and pharma. How do they weight that index? I think is the question.
So for biotech specifically, the big benchmarks are IBB, which is an ETF that tracks the NBI, which is NASDAQ's biotech index. IBB is by far the largest. XBI, and that's all biotech. Okay, so it's actually 50% weighted towards the larger names: Gilead, Amgen, Biogen, etc. So that's heavily weighted towards the larger cap names. XBI is more small cap weighted or equal weighted, and gives a little more sort of more indicative of how the small caps are trading. But in terms of the device space and the services, for the most part, I tend to focus more on the drug developers. That's what I'm most interested in anyway. Again, I'm a bit of a nerd, and I like to read about the science. So those are obviously, they have their own indexes and ETFs that you could track. I'm not sure I answered the question very well, but
I'm not sure I asked the question very well. Okay, so Carlton would like for you to discuss a little bit about the run-ups in bios, like why and what to be careful around, like when they're running up like that. What's the real, I guess, the risk when they're running?
So the bio run-up is a trade that's worked really well for the last 3 years, and all it is, it's an anticipatory trade where you're getting involved in sort of the 3 to 6 month period, maybe even a little less, before a big event, phase 3 data or a drug approval, and these stocks just kind of tend to trickle higher in advance, and that's just people getting involved in anticipation of this big stock moving event, right? So that's kind of like been a trade that's worked really well for the last 3 years. The last 6 months hasn't worked very well, but I expect at some point that'll come back into favor again. So I don't know. I'm not sure I can get into like details on the run-up trade, but we'll definitely go into detail on that in the March 19th webinar.
Okay, yeah, there's tons of questions here that we're not going to be able to get to because we're out of time. So why don't you, there's his link. It's propthink.com/thirsty. He's going to make it available for a couple of days. So if you're going to get involved, you should now. It sounds like you guys have tons of questions. His site is propthink.com. And Jake, I'd like to thank you very much for coming and spending this hour with us here.
Thanks a lot, Jeanette.
Sure. All right. Well, hang on 1 second and let me remove you. And if we get any other specific questions, we'll forward them straight to you.
Real quick, Jeanette, just let me say, you can email editor@propthink.com, or I'm also on Twitter at Faja Jake, F-A-J-A-J-A-K-E. I am a Faja, a father. So that's where you can find me. And at PropThinker as well, at PropThinker.
Okay, all right. And so that's also email, the email is editor@propthink.com.
Yeah, that's the best. Or support. That's right, support at PropThink.
Okay, support at PropThink. All right, lots of ways to reach Jake, guys. So
thanks, everyone.
I'm going to go ahead and dismiss him. All right, thank you for coming. Let's see.